Good day, everyone. My name is Marie Muldowney. I'm the Managing Director at CSI. We're part of Moody's Analytics. I'm pleased to welcome you to this webinar, Advisor's Guide to Digital Assets, with Sean Shore and Christina Dolan. It's a very timely topic given all the movement in the market and the demands from clients for advice on cryptocurrency. So just a few housekeeping items. Today's webinar is being recorded. The ratings, financial reporting analysis, any projections, or other observations constituting part of the information contained in this webinar must be construed solely as statements of opinion and not statements of fact or recommendations to purchase, sell, or hold any securities. We ask that no one record this webinar without Moody's explicit permission. Lastly, no one has permission to quote any of the comments or questions asked by the webinar audience. Please note the following presentation is being offered by Moody's Analytics, which operates independently of Moody's Investors Service, the credit rating agency. For optimal listening, all attendees are currently muted. If you'd like to ask a question, please enter it in the Q&A box at the bottom right-hand corner of the presentation screen. Also note that there are no continuing education credits available for this webinar. Marshall Bayer will be managing the webinar, as well as the question and answer session. So please put your questions in the question box and he'll manage them as we go. Marshall is the Senior Director, Credentials and Licensing Strategy. He's responsible for our learning and credential strategy for the securities area. So I'll turn the webinar over to Marshall. Go ahead.
Thanks, Marie. So welcome to the Advisor's Guide to Digital Asset webinar. Digital assets, of which crypto is part of a subset which utilizes the blockchain, is not going away. Yes, despite the extreme volatility we have seen recently, particularly today. As much as old guys like me might be somewhat resistant, and yes, even a bit skeptical, there's no disputing the tremendous institutional adoption of crypto from both a treasury and investment perspective that we have seen, and that which has been accelerated this past year. We know you as advisors are getting lots of questions from your clients. We are offering this webinar to help you build your knowledge base in this area. We also offer a 5-hour continuing education course entitled Bitcoin Opportunities and Risks, which you could find on our website. We are fortunate to have Christina Dolan and Sean Shore here with us to present. Christina, who will speak for around 30-35 minutes or so, will give us the big picture. She is an MIT credentialed engineer, computer scientist, and entrepreneur that has led the transformation of businesses and built revolutionary products utilizing advanced technologies across many industries. In addition, she is a co-founder of several blockchain-enabled companies. Recognized as an industry thought leader, she has received numerous honors, including 100 Women in Finance, Women to Watch in Crypto and Blockchain, 100 Most Influential Blockchain Women, and Thought Leader in Crypto and Blockchain. Sean Shore will speak for around 15 minutes or so on the crypto regulatory and compliance status and considerations here in Canada. He is a graduate of the University of Manitoba's Faculty of Law and the London School of Economics, and is a lawyer with Canadian compliance and regulatory law, which he has practiced in since 2014. His practice is focused on the regulation of individuals and corporations that are registered in the Canadian investment industry. As part of that role, he has worked with and consulted with regulators and crypto product manufacturers. Sean was previously a chief compliance officer for an independent IIROC member firm. We are going to leave about 10 or 15 minutes for questions after the speakers present. Please use the Q&A icon at the bottom of the screen to write in your questions as they come up, and we will get to them in that 10 to 15 minute period. And if not, we'll try and get to them after this presentation. So without any further delay, here is Christina.
Marshall, thank you so much. Can everybody hear me? So I'm very excited to be talking to you about digital assets and giving this presentation on the Advisor's Guide to Digital Assets. And the reason why I'm so excited about this is because as an entrepreneur and as an engineer that has worked in fintech and has also had a front seat at the transformation in the media space as well as the e-commerce space, I look at this space and realize, wow, this, connected technology that facilitates a new form of payment that has a sense of community is incredibly powerful. And the amount of transformation and opportunities that are going to occur as a result of that are really, really exciting. So today, what I'd like to make sure that you walk away with is an appreciation for all these different layers and facets that create value within these digital assets, and get a sense of what a digital asset is and what makes it different and unique from other assets. So let's get started with the next slide. So let's start with the rise of Bitcoin. What's interesting is that there were a group of people that were working on these technologies, but we took this perfect financial storm, which created doubt in the minds of a lot of people with respect to our financial systems, that really helped give birth to this Bitcoin. And I look at Bitcoin as being sort of like the grandfather of all these digital assets, because in its cleverness, they created this decentralized network that, by sort of using cryptography and copying all transactions throughout a network so that they couldn't be changed, this enabled a kind of a new paradigm with respect to financial transactions, store of value, and payments. And what's really exciting is this network effect, which I'm going to talk a little bit more on the following slides. So in the next slide, what's interesting is if you think about crypto, this category of crypto, it's only been around for 12 years, right? And over the course of time, obviously crises like the global financial crisis that kicked it off, and the Cyprus crisis, in which money was being pulled out of people's accounts, and of course, that created an emphasis on Bitcoin. And then, of course, the most recent COVID crisis, there is this sort of economic component to this. But in 2015, Ethereum was created, and that was what created what I would say is the programmable money and programmable financial capabilities. And while that also kicked off this ICO-fueled hyper-innovation, a lot of ideas that were tested and created a lot of excitement. I mean, some ideas obviously didn't make it, but other ones really tested the regulators. And of course, Sean can probably talk a little bit more about that. But if you look at over the course of the last few years, in which you've had an incredible amount of institutional adoption, the amount of innovation in terms of things like financial products and utilizing blockchain to sort of simplify trading processes. It's been amazing how much has been done in the last few years, and the size of the community that's been created. As a matter of fact, within that community, you even have pockets of investors that focus on venture capital and building the technology around it. So it's a very exciting journey. It's not very long, but it's gotten incredibly exciting over the course of the last few years as the institutional organizations have engaged and really given it credit. So in the next slide, so you're probably wondering, so what's a digital asset? Now, maybe some of you already know. And according to some statistics, I think 95% of Canadians have a credit card and can complete a digital transaction. But of course, that's not a digital asset, right? A digital asset has a store of value, right? And so obviously the first and the grandfather is Bitcoin, which sort of was launched as a store of value and transactions, right? And then Ethereum, as I mentioned, was what introduced this programmable layer. And most of the distributed finance that you're hearing about, these non-fungible tokens that we'll talk a little bit about, all of this was launched on Ethereum. And there are a number of other coins that we'll talk about as well that sort of came from, that were inspired by this programmability. But let me just differentiate between a digital asset and a crypto asset. So cryptography obviously is a component of what is a crypto asset. And typically they have a economic layer that's built off of this technology. You have a conduit for peer-to-peer effective transactions. And then you have a blockchain, which is this distributed ledger, which is what creates a sort of immutable, unerasable record that's locked with cryptography. So it's important to note that not all digital assets are crypto, and that not all crypto is decentralized. But for the purposes of this discussion, it's important to note that cryptography is a component of crypto assets. So in the next slide, I'm going to talk about this network effect. And I sort of alluded to it before, but I think what's really, really interesting about this technology is the network effect. So one of the examples that people like to talk about is McDonald's, right? And McDonald's, in terms of the equity stakeholders, the people who own shares or invest in McDonald's as a company typically is not the same community as the people who like to consume its product. And the stakeholders that are involved are not necessarily involved in the strategy, but in this crypto world, there is an overlapping ownership in terms of the overall strategy and engagement in the community. So why is that important? Well, if you look at it from Metcalfe's law, which applies to telephones and social networks, every entity that joins a network creates value in it, right? So I'm sure that recently there's been a lot of folks that have been inviting you to join their particular new chat network. And then you probably think to yourself, well, why do I want to join if I don't have any friends on that network? And so that demonstrates the value of how many friends you have on a network and how many friends you bring onto that network and how you engage in that network that creates a tremendous amount of value in that network. And that's a characteristic that you see in these crypto networks. The next slide. So there's all kinds of digital assets. So I think it depends on where you look. I mean, I think there's been like over 7,000 crypto assets that have been announced. And I think about only 4,000 or so are actually active, depending upon who you ask. But it's interesting, they've all sort of evolved somewhat differently, have different characteristics. So, I mean, obviously Bitcoin was sort of the grandfather, and obviously as historic value, it's definitely held in high regard. But you have a variety of other coins that have evolved. So, for example, you have coins that are mined, on a blockchain network, and miners are rewarded for that. You have the developers within these crypto environments that might have a disagreement, and that's going to create a hard fork and generate some more coins. Some coins are used primarily for payments, and there are blockchains that don't have any coins or don't have an asset that is used on that network. There are different types of mechanisms by which to create this immutable record, and staking is one, proof of work is another. You have privacy coins that don't have the level of transparency that you get out of Bitcoin, some of these others. And then talk a little bit more about that, because that's a wonderful thing. And in terms of utility, Ethereum has a component of utility in it. Many of you probably have heard of the non-fungible tokens, which have made the headlines since somebody recently paid close to $7 million for a non-fungible token. You've got stable coins, which are used a lot for trading. And it's interesting because on these trading platforms, the stable coins are used a lot, which is one of the reasons why by volume they are such a large class within crypto. And then, of course, you have the central bank digital currencies. So in terms of the next slide, this is the slide that I borrowed from Union Square Ventures. And I think it's important to look at it from this perspective. Once again, remember, I said that what's interesting about crypto and these communities is it has many different facets of value. It's not like an FX currency pair in which, the global economic indicators have some sort of impact. This has a lot more a lot more different facets associated with it. And so one of the analogies that I like to use is, for those that remember when the World Wide Web came out, you had this free protocol layer that enabled the ability to build applications. And then you had investors and entrepreneurs that created these entities and companies that created value on top of the protocol. And that's where the value was created for those stakeholders, right? In this Bitcoin blockchain world, you have a lot more of the value in the protocol layer, and that has been created. And there's lots of different different versions that have come out of different use cases. So, for example, in the next slide, here are some layer 1 protocols. If you go back to the prior slide, these are some of the layer 1 protocols like Bitcoin, Ethereum, Litecoin, Polkadot. They all have different features. They were kind of created because they could do different things. And they gave birth to applications. So in the next slide, you'll see a number of the applications. If you could just go back one, in terms of the layer 2, there, from an application layer, there are a number of applications that have evolved from that. What's interesting is Ethereum has given birth to this whole DeFi category, which we're going to talk about because it's doing extremely well. It's also given birth to the non-fungible tokens and a variety of other interesting layer 2 types of applications, and of course the ICOs as well. So in the next slide, you have the non-fungible token market. And I'm going to focus on this for a minute because I think it's worth noting that while, yeah, it's fun that Beebles got, close to 70 million for, for his artwork, I think that there's a lot of other use cases. Now, keep in mind that, NFTs, this is built on Ethereum. And what's interesting is that it has these smart contracts. And so, for example, if we were to sell stadium tickets utilizing these non-fungible tokens that provide a sort of contractual, right to something, if you were to sell a ticket for a stadium, you could actually create a commission. You can build in a commission so that if somebody resells the ticket, you get 10% that goes back to the house. But for example, if it's the playoffs, then you can actually change the commission to be a greater percentage. And so there are a lot of interesting use cases that I think you're going to see, marketing organizations utilize, right? And then also luxury goods. That's been an area in which has been a lot of fraud. And so the ability to sort of certify ownership is going to be another clever use case. So, these are some examples of how the Ethereum network is going to be fueling applications. And while these might not be what I consider to be, securities per se, the usability of this network is going to generate a lot more traction for Ethereum. So in the next slide, I had mentioned stable coins, and I think it's important to note that stable coins are used a lot because of trading. And when traders are trading in and out of crypto, to be able to use a stable coin that is pegged to a US dollar means that they can pull out of crypto to eliminate some risk, but not have to move their money off into a traditional bank account, which can not only take time but have fees associated with it. So they play a big role in trading. And so the question comes up that there's over 80 countries now that are talking about these central bank digital currencies. And the question is, what are the characteristics of these coins? And it's not clear if they will be crypto or if they will be distributed or if they will be public blockchains, which we'll be able to see some of the analytics. It's not really clear. But what some people fear with respect to the central bank digital currencies is that it will be programmable money. And so some people are concerned that you'll have automatic fees and automatic taxes. And so, the question always comes up, will the CBDCs replace stable coins? And some people argue that CBDCs will be used transactionally, but because of the programmability, not understanding that, there may be an interest in utilizing the stable coins or some of the traditional crypto to store money or store value. So in the next slide, what's also important to note is as these central bank digital currencies start moving towards a sort of new technology, new rails, you're going to have new infrastructure to support that. So for example, if the central bank digital currencies then require that you keep your account, as a digital wallet that's not necessarily stored at the traditional bank. How will those services differ? Because traditional bank accounts use fractional banking, and that fractional banking means that for every dollar you put into a bank, 90% or 95% of that is lent out for companies that need capital, or individuals trying to buy a car, whatever that might be, right? So how those business models work. Now, I talked about how DeFi digital services have been evolving in this crypto world, and as a matter of fact, today you can get 4, 8, 12% from your stable coins and crypto through these DeFi services. So they're becoming quite popular, but we're going to have to, in order for these central bank digital currencies to be implemented, we're going to have different infrastructure to support this. So in the next slide, I talked a little bit about distributed finance. And so what is that? Well, what's interesting is over the course of the last couple of years, the ecosystem around crypto has grown up, and you have a lot more institutional organizations, and you also have a lot of applications. You have lending, investing, insurance, you have digital marketplaces. And so the level of sophistication in this space has gotten quite significant. There's I just read that CoinGecko had a statistic that over 100 million is in total value locked in this DeFi space, and it's grown very quickly over the course of the last few months. And one of the concerns about this space, obviously, is that the interactions with this space are somewhat sophisticated. So if you don't have a lot of customer support or intermediaries to fix problems, it becomes more important to have the skill set to be able to use these platforms. In the next slide. So why invest in digital assets, right? And this is an important slide, because one of the reasons why crypto is attractive is because of what's going on with fiat currencies all around the world. So obviously with all the printing that's going on by all of the central banks around the world, that basically debases the currency, which in essence means that the buying value of money that we have in dollars or Canadian dollars or whatever government money is decreasing. And there's statistics that it's 15% a year, 2%. It's a little bit debatable because of the basket of goods that they're being looked at. And then in addition to that, the yields, in the UK, negative yields, the yields for putting your money in the bank not only is decreasing in value, but you're not getting that much of a return. And in addition to that, the central bank balance sheets are exploding. And meanwhile, the asset value of things like, homes or, things that you really desire, like in the United States, it's healthcare and education, those are going up exponentially. And so this creates a bit of a wealth gap. So of course, this has attracted a lot of individuals towards crypto because of all of the things that are on this slide. They're trying to hold on to some of their buying value. Of course, with the drop in Bitcoin, I don't know if you could hold on to that. But anyway, we'll get to that later. In the next slide. So in terms of performance, obviously Bitcoin is, a volatile asset class. But what's interesting is that it has outperformed in the long run in 2020, right? If you look at gold and the S&P. And so originally when the COVID crisis first took place in the first quarter of last year, what's interesting is that you did see an immediate sell-off. And the reason is because it's liquid, right? I mean, you won't be able to sell gold that quickly. But you notice that if you look at the, at the Bitcoin line, the orange line on that slide, you'll notice that it bounced back a lot faster and it did much better in the long run. And so the more money that's printed, the more that the more likely that people are going to be attracted to moving the money out of traditional currencies into central banks. I mean, sorry, into Bitcoin and cryptocurrencies. So in the next slide, so I mentioned that Bitcoin is has a significant amount of volatility, but it's also deflationary. So what's interesting is that when Bitcoin was first announced, they made it very clear that there will only be 21 million coins, right? So as opposed to the central banks that just print and print, and there's the sort of debasing of the currency. The sort of economic principle behind Bitcoin was that there will only be 21 million coins. Now, just to be clear, not all cryptocurrencies have that limitation, but Bitcoin did have that limitation. And so as a result of that, the idea is that it's a deflationary currency. And if you look at it compared to the other typical investments that people like to compare it against, like gold and the S&P 500, Bitcoin has done quite well. The next slide. So in terms of monetary properties and analysis and signals and ratios, one of the things that I love about blockchain and the cryptocurrencies that transact on them is the fact that you have all these analytical data that's available. And it would be really nice if the central bank digital currencies would make their digital currencies crypto on a public blockchain, so we could all see these types of signals and information. So, for example, when there is some sort of initiative that government makes payments out to the population, you'd be able to see the velocity of money and how effective it is at transaction, being included in transactions, or is it being held in wallets and not being used. And so you can see from these statistics, which I pulled off of a website called blockchain.com, you can see how many wallets are total circulating Bitcoin. I mean, you don't know how much gold is in the market cap with this level of detail. So this is one of the beautiful things about crypto. In the next slide is the transparency. And one of the things I absolutely love about the blockchain-based cryptocurrencies is that you have transparency. And what's interesting is, I spend a lot of time in the cybersecurity space, and it always annoys me when I hear thought leaders talk about all the crime and people that transact in Bitcoin are criminals. And the thing is, if you're going to be a criminal and you're going to use blockchain for payments, people are going to catch you because it's very transparent. You can see the transaction journey. There's a global database for stolen crypto or crypto associated with some sort of a crime. And so from a regulatory compliance, AML-D5, there is a lot of information that's available through the blockchain. And so once again, if the central bank digital currencies were to adopt a sort of public blockchain, we would have this kind of information that would be available. You do not have this type of transparency in traditional financial systems because they're siloed and the money is fungible. So if it goes to one account and it gets dispersed and moved, it's not the same transaction journey. And so it's a lot more difficult with traditional financial systems to be able to follow the money. So I think it's important to note that crypto does have an incredible transparency. And this chart is from Chainalysis, which is a unicorn here in the United States. It's working with all of the agencies around the world to help capture criminals. And if you Google them, you'll see that they've caught a lot of criminals over the years. Next slide. So how to invest? So you can invest directly. And I always hear people say to me, I wish I'd bought crypto or bought Bitcoin 10 years ago. And I laugh because I tell them that if you had, you probably would have lost the password, you would have lost the keys, and then you'd be annoyed that you bought it and you didn't have it anymore. And the thieves are actually very creative. I mean, they are able to port phones for people who store their crypto on their phones, or be able to reset passwords on email addresses and get into accounts. So it's hard to buy crypto and hold on to your on your own. But in order to be able to do that, you need to have a public key, which is like an address, and then you need a private key, which is like your password. And what's really clever is that together that creates a cryptographic signature. So the recipient just needs your signature and your public key to verify that you have the correct password. You don't have to give them the password, and then you're able to complete the transaction. So that's one of the really clever aspects of utilizing cryptography in this transaction process. And of course, then once that information gets into the blockchain, it can be verified as to whether or not the person who is transacting is actually the owner of that cryptocurrency. Next slide. Now, there are a variety of other ways that you can transact with crypto, and so peer-to-peer is pretty straightforward. If you have a wallet, and electronic wallet, you can actually designate and move crypto from your wallet to somebody else's wallet, provided you have the private public keys. You can go to an exchange and upload money or move from your account to one of the popular crypto exchanges. But if you want to get one of the less popular cryptos, you'll probably have to go to one of the big exchanges and get one of the popular coins like Bitcoin or Ethereum, and then take that to a crypto-only exchange and then convert that to get one of the lesser known crypto coins. And then of course you have centralized exchanges and decentralized exchanges. You have these Bitcoin ATMs, which have been used a lot by, especially in a variety of different countries, by folks who don't have a bank account, to be able to convert cash into Bitcoin and send it to somebody in a different part of the world. But of course, once again, how you custody and hold onto your crypto is really important, because if you leave your money on an exchange or on your phone, the likelihood that it can be lost or stolen is pretty high. And so learning how to create a mechanism for storing it on paper or hardware wallets is a very, very important component to being a crypto investor. In the next slide, obviously there are a lot of crypto investment vehicles that make it a whole lot easier to hold crypto without having to go through that whole process. And of course, there are trading platforms and exchanges and brokerage accounts. Self-managed brokerage accounts now have the ability to be able to buy cryptocurrencies on them. You have a variety of different types of products like exchange traded funds, closed-end mutual funds, and trusts. There are derivatives, futures and options, which are quite popular. And then there are hedge funds and venture funds. And there's a very large community that's starting to form that invests not just in the coins themselves, but in the ecosystem around the coins, the services and technology and hardware that's involved in creating and supporting these coins. Next slide. So how to invest? Now, it's interesting because recently you've seen a number of corporate treasuries that have actually invested in Bitcoin. And if you think about that slide where I talked about how the purchasing power of traditional fiat currencies has decreased with all of the printing of money that's occurred, a number of corporate treasuries have decided to put their holdings into Bitcoin. And of course, MicroStrategy and Tesla have been in the news a lot. I mean, Tesla actually at one point made more money from their Bitcoin holdings than they did from selling cars. But there are a number of companies that have actually made this big move. And this is just one of the indications that demonstrates that the institutional acceptance of crypto assets is continuing to grow. Next slide. So how to invest in the technology and services piece of that is tricky for sort of a retail investor who may not have the opportunity of investing with a hedge fund or a venture fund. But some of the companies that are listed here are involved in a variety of different aspects of crypto. I mean, obviously, NVIDIA is in the chip business, MasterCard is in the transaction business, and PayPal and Overstock. Advanced Micro Devices also is in the chip business. So there are a variety of companies that have had the opportunity to provide a variety of services to this growing industry. Next slide. So in terms of portfolio benefits, historically there has been a lower correlation Bitcoin and to traditional asset classes. So it's actually been an attractive tool for portfolio diversification. And in 2020, though, the correlation to traditional asset classes was actually the highest on record due to the increasing adoption on the institutional side and record volumes that have been traded. And next slide. Also in terms of portfolio composition, there is a risk reward benefit. And I borrowed this slide from Morningstar and VanEck, which actually shows some of the asymmetric portfolio returns. And so you'll see that even with going from a 1% to a 3% Bitcoin holding has significant improvement in the cumulative returns. Next slide. Now, what's interesting is that the correlation between different crypto assets is actually, pretty high. And the reason is because, as I explained to you before, if you're buying a lesser known cryptocurrency, you kind of have to go to an exchange that takes fiat and allows you to get one of the popular cryptocurrencies, so that you can go to a crypto only exchange to buy one of these other cryptocurrencies. But in addition, the people who have been investing in this space and really understand the nuances of all these different cryptocurrencies and the capabilities they bring. So, for example, understanding the value of Ethereum and how that programmability is launching these new sort of financial opportunities, et cetera. I mean, the group of people that's investing in this asset class tends to invest across the asset class. So it makes sense that the whole, the whole crypto asset category would have high correlations. Next slide. Now, I am always very cautious of cyber risk, because I think that as we move into this sort of networked world where value is now digital, you have to be even more careful. And obviously the hackers have gotten to be very, very creative. And one of the things that they like to do is go to the exchanges, because there's a concentration of value stored there. And a lot of people just leave their keys there. It's kind of like parking their car on the street and leaving the keys in there and thinking they'll be there when you come back. So there's a lot of fraud, there's a lot of hacks. When there's a fork, some people are not aware of how to manage that process. The economic drivers for crypto are a little different than they are for traditional fiat currencies and fiat pairs, right? I mean, those are pretty much driven by political and economic indicators. Where in the crypto space, you can have a celebrity that says that Bitcoin utilizes too much energy, even though ARK Investment has said that 76% of the energy that's used for Bitcoin mining is actually renewable energy. But it just takes one comment to actually really affect the market. Now, you're also seeing today that the concerns about inflation are affecting the market as a whole, and are now also affecting the cryptocurrencies. But in the crypto space, you also have things like whales, in which they have very large holdings of crypto, and they make a big move and it spooks the market, or creates some concern, and so that in itself will affect the price. In the next slide. So due diligence and suitability is an important one. And I think that Sean's probably going to talk a little bit more about that. But as I explained, you know, cryptocurrencies have many different facets. They're extremely volatile. When you get into the distributed finance products, it can get kind of complicated. And so the average person may not be able to know how to invest or hold on to crypto themselves, may not understand the volatility, may not be comfortable with it. And so it's important to understand the needs of customers. But in addition to that, you also have things like, you know, the fees and performance, and who are the people that are managing the fund? You know, do they really understand the space? What's the strategy for the fund? And I think the most important aspect is the cyber risk, because the cyber risk in this space is huge. And you know, unfortunately, I think that you know, the hackers get more and more creative every day. And then, of course, the AML, you know, anti-money laundering and KYC in this space, because of the transparency, is something that could be managed very well through the transparency of the technology. So with that, I think at this point, that's my last slide. So I'm going to hand this over to John.
Thank you very much, Christina. That was fantastic. And I think we have seen from today's market volatility that there's always something to talk about, and the market has cooperated to give us lots to chat about today. I know Christina and I aren't authors of the volatility, but we're certainly happy to discuss it with you. So we can go to the next slide now. As I mentioned, you saw on the slide before, I'm going to be chatting briefly about compliance considerations that registrants should be considering when clients come to them and start having conversations with them about their interest in this space, in the crypto asset or digital asset space. And for these purposes, I'm just going to be referring to either Bitcoin or Ethereum, or generally just digital assets. So there's my agenda for today. How did we get there? What are my medium of investment possibilities? Some of the usual issues that retail investment advisors and other registrants are going to be familiar with, some brief chats about tax considerations, and then what's next. So the next slide, please. So, you know, as I started to prepare for this presentation, I realized that there was just an incredible number of conversations happening out on the street from end client investors saying, I keep hearing about digital assets. How do I get access to digital assets? Tell me what digital assets are. And I can't imagine what the end advisor, end registrant is having to deal with clients who are coming, hearing about this. They're actually hearing probably about how much money people have made. They're hearing about how much money their friends' children have made, and they want to get a piece of it. So I wanted to start off my slides with that as a backdrop, because I think in order to sort of really start the conversation, we have to talk about the Bitcoin Fund and 3iQ and the decision of the Ontario Securities Commission. So we can go to the next slide here. With this, you had, as I said, a lot of people creating this demand for these types of assets. And as a result of that, I can imagine that questions are going to be coming in, and there really wasn't as much of a mainstream product at the time, other than as what Christina has spoken about. I can invest directly in native tokens. I can go through a different type of exchange. I can hold it in a wallet. But up until now, there wasn't as much availability in terms of a mainstream fund. So why am I telling you about this? I'm telling you that from my perspective, this is a worthwhile decision to read, because if nothing more, you're going to see how the access point to digital assets came to be, at least in Canada. And what's important, and this is why this decision has application regardless of what type of asset we're talking about, not just digital assets, but any type of investable asset that you might be giving advice on, is that this isn't about legislating the asset or adjudicating the asset class itself, but it's rather about securities laws being followed, for example, like full, true, and plain disclosure. And with that, we can go to the next slide. And here's where I think the rubber is going to hit the road, where if you have read a prospectus, if you've had the joy of reading a prospectus, you're going to see in that top area there that no securities regulatory authority will ever express an opinion about these securities as securities themselves. And in the paragraph that I've highlighted there, it's outside of the scope of the authority of the securities regulators to immunize against risk or loss. And it's certainly not their job to ban speculation or risk taking, regardless of the investment. And I'm not suggesting or creating doubt or suggesting that digital assets are more or less speculative than anything else. That's not what I'm here to say. What I'm here to say is that if we look at this objectively, what they're saying here is that digital assets are no different than any other type of investment asset that might come into your desk or to your office for a client to chat about. Right now, we're seeing that they're very volatile. So some people might say, are you crazy, Sean? Of course they're different. They're way more volatile. But I'm not looking at it from that perspective. I'm looking at it from a client saying, I'm interested in something and I'd like you to talk to me about it. And when we go into that perspective and say that the regulators are not here to prevent clients from taking risks, then I think we can distill it down to very, very basic concepts. We can go to the next slide. And here is where we really get some more direction. Novel asset classes and securities products sometimes fail. They become tulip bulbs or .coms. Others succeed, others do not. Securities regulators are not mandated to pick winners or losers, and neither are investment advisors. You're there to guide people, to guide clients based on our regulatory expectations. And that's what we're going to talk about in a moment. So the next slide, please. So how do we invest? Clients may be asking, how do I get access to this sort of action and volatility? And Christina mentioned this already, and I'll just deal with it quickly. Sometimes clients can access tokens directly through an enterprise like a money services business where they're holding them directly in a wallet of some sort. Other times they can do that through an exchange. And really, I'm just touching on this because I want to focus obviously on number 3. Which is really what a retail investment advisor might have the most questions coming in at them on. Obtaining exposure through a prepackaged product like an ETF or a closed-end fund. And those are going to be offered by our traditional offering documents. So if we go back a second to what we talked about earlier, you had this pent-up demand for anything digital, anything crypto. I want to have access to it. It's really complicated. These wallets, really, I don't understand them, and keeping passwords, and that's too complicated. Because we have to remember that do-it-yourself investors can access the marketplace via an order execution dealer and conduct trades at $7 a trade, or they can call their full service broker. And really, the access to these investments are effortless. Now that we have something that's more wrapped up, like an ETF or a closed-end fund, this created the opportunity for retail investors, mainstream investors, to start accessing certain digital assets like Bitcoin, Ether, and so on. And I would point out, as we know, that each of these presents different opportunities as well as risks, and it's purely a user-driven choice. Christina highlighted that beautifully by saying, well, if you're going to have direct access, you have to keep your passwords, and you do it on paper, and so on. So let's go to the next slide. So here's just an example. Obviously, we're not recommending or suggesting any one of these in particular. It's just sort of what's out there right now. And as we'll talk about in a second, it's so important for registrants to understand what it is they're buying, or what it is they're buying for their clients and customers. And in some cases, some products will be different than other. And there can be issues like I've identified on the far right there in terms of the tracking error issue that it's worthwhile to talk about and to educate yourself on. That's purely a know your product issue. And I don't think we have to get into the significance and importance of knowing your product, in particular when we talk about leveraged and inverse ETFs and the challenges that posed in the marketplace several years ago. So let's go to the next slide. So what are the issues? Well, I hope this isn't surprising to anybody who's watching. The traditional issues that you're going to have to educate your clients on, the triumvirate, know your client, know your product, and suitability. And I only need to remind us all that client-focused reforms are coming. It's been one of the most talked about regulatory initiatives in a long time. And as that marches forward to the end to June 30th and the end of the year, December 31, I think it's a great idea for us to refresh this conversation about the importance of getting back to the basics, especially when you've got clients coming in chatting with you about assets or asset classes that you may not have a lot of familiarity with. And these are the things that are going to save you in the long run. Obviously, note taking, it goes without saying, but when you're talking to clients about crypto or digital assets, it's especially in the know your client area, what is your risk tolerance for this? And how much should you or do you want to be investing? And the key, and you're going to earn your keep here, is by getting clients to understand that it's not as easy as it seems to make money on these assets. And as we're seeing today, you can have extreme volatility. And one of the things that I came across, which I found fascinating, was those individuals who are investing directly into these tokens. It's really not as easy to get in and out of these as it's made to seem. Certainly a different approach than when you're calling your broker or going on through an online website to place your trades directly. So these are the things that I really encourage people to be focusing on. I'm going to get into know your product in a second on the next slide, but I think, I can't highlight enough the importance of that. So, here's a great, I couldn't help myself, but we have our friend here, Bill Gates, saying, okay, well, this is a risky area. And he comes out and says a couple months ago, my general thought is that if you have less money than Elon Musk, you should really probably be careful here. And that's a pretty hilarious comment, given at the time Elon Musk had more money than anybody on the planet Earth. So the suggestion here is that anybody else other than him should be cautious in investing in any type of digital asset. That's not what I think we're here to suggest at all. It's just to suggest that caution should be exercised. Educate yourself as you normally would. And if you're a registrant, make sure that you've clearly pointed these issues out to their clients. Next slide, please. So in terms of knowing your product, and we've spoken about the closed-end funds or ETFs, I think it's really, really important for the investment advisor to have a look at the offering documents and to really understand what these offering documents identify in terms of risks. And Christina mentioned this a little bit already, but I'll focus the conversation in terms of the know your product issue. So the nature of the asset class, the nature of digital assets, is that they may be more prone to, for example, cybersecurity issues or hacking. The transactions are generally permanent. So if, for example, a transaction occurs, it can't be reversed. So if there is something that's stolen from you, it can't be reversed. Also identifying the insurance issue. These are the things that I would be focusing on when I'm looking at the offering documentation, to make sure that I understand that if I'm invested in a fund, for example, or an ETF, that what is the nature of insurance that they've obtained? Who's the custodian that they're using? And now we have an emergence of licensed custodians, some of them down in the United States, who are gaining more experience in this area. I don't have to name names, but we all know who they are. And these issues are slowly falling away. So several years ago, I think you had innovation really outpacing regulation. And I think now we're getting a little bit more comfort with this space, because the traditional mainstream methodology of investing, which talks about custody, segregation, insurance, and so on, is now being applied over these types of transactions and these types of assets. So again, understanding and reviewing these specific asset risks is critical for the client, and it's critical for you in terms of whether or not you're going to be making any recommendations in this area. Next slide, please. A brief word on tax considerations. The simple answer is they're taxable. And that really is going to depend on the type of investor you are. If you're someone who doesn't do this for a living, the usual rules are going to apply: capital gains, capital losses, et cetera. The short answer is speak to your tax professional. If you use TurboTax or one of the online preparers. I even got a warning when I saw returns being prepared this year that, hey, have you invested in crypto? Because if you have, it may be a taxable transaction. So pay attention. Next slide, please. And finally, what's on the horizon? So we have over the last couple of weeks received some guidance from the Canadian Securities Administrators and they've said, look, the regulation of crypto asset trading platforms is on the way, and they've released a couple of staff notices saying that there's going to be two broad categories of regulation: dealer platforms and marketplace platforms. And by the way, if you are operating in Canada, offering services to Canadians, you better call us, because we're expecting you to apply to comply with the rules, with securities laws generally. And if you don't, we're going to enforce them against you. So I just wanted to touch on that very briefly. It's something that's coming. It's certainly welcome, because I think that's going to gain and lend legitimacy to this space and help end investors with that. So with that, I know that I breezed through, but I didn't have a lot of time. So that's my last slide.
Great. Thanks, Sean. Thanks, Christina. That was great. And I realize we crammed a lot of information into a very short period of time. Maybe we'll have a follow-up to this at some point in the future. But in the meantime, there's lots of questions. We're not going to be able to get to them all, unfortunately, but maybe we can go a few minutes over time, if that's okay with you, Sean, and Christina. And at least we can get some of the questions answered. First one, and I'll just go in the order in which they were written. Bitcoin is down quite a bit. Ethereum is down quite a bit. Are these truly currencies or simply ultra speculative commodities? And I think it's a good question, is how can they be mediums of exchange with this amount of volatility, or credible mediums of exchange with this incredible amount of volatility? And I guess that's maybe a Christina question.
So, of course, I'm not a regulator. I'm a technology person, and so I'm going to have a very different view than Sean. But obviously, there are a lot of sort of emotional factors in this space, because it is a community. You have that network effect. So when Elon Musk comes out and says, "Hey, not no more Bitcoin, because you can't buy a car with Bitcoin because of the energy that's consumed," it does in some ways affect the market. But I think that to some degree, the economic idea of these currencies is that you're kind of in a world that is trying to escape the printing of central banks, right? And as soon as the banks start to say that they're going to the long tail in terms of interest rates is going to rise, and then all of a sudden the investors start thinking to themselves, okay, wait a second, so how is this going to work? So I do think that it could be considered speculative, but as more and more applications are built, on the foundations of crypto, from the non-fungible tokens that are being used for marketing, et cetera, in which you have to use these cryptocurrencies to fund that. I think that at a fundamental level, there is still going to be a growing need for these technologies as we move infrastructure in that space. But I do think that on a day-by-day basis, they're highly volatile. And I think that that's why the know your customer aspect is very important. So.
Okay, thank you. There's been recent bans of crypto in Turkey, South Korea, etc. Also, India is considering a ban. What impact will this increasing regulatory scrutiny and outright banning of crypto have on the market in the long term?
Well, I'm sort of laughing. China had a ban, and you still had a lot of Chinese that were using these cryptocurrencies, especially in the ICO space. So I think that the more capital controls you put in the fiat world, the more likely you are going to drive people to other currencies. And because of the ability to use sort of network protocols and bypass any sort of ring fencing and IP addresses, people really want to do it. It isn't that hard. I think it's harder to convert into fiat and move it out of a country when there are capital controls than it is with cryptocurrencies. But that's just my opinion. So Sean probably has a better regulatory view on this.
Look, my desire is to make sure that registrants are protecting themselves, and whether or not a state comes along to impose restrictions or controls or what have you on a particular asset, in this case, digital assets. I only look at the outcomes in terms of what impact could that have on value. And if it destroys value, then end customers are going to be potentially motivated to complain. And that's the space, that's the area of the world that I tend to deal in most. Why did I invest in this? Why did you tell me to buy this? I can't believe I lost money in this. That's sort of the complaining that I hear about most typically, which is why the focus of my slides is really on getting back to basics. This is just another asset. This is just another transaction. How do we manage risk? How do we provide excellent service to clients? How do I know my client? Do I know my product? Is this suitable? Providing that advice is key. Whether or not, contrary to popular belief, I don't think Christina or I control Elon Musk or the crypto market or what have you. So we're in the same position as everybody else. My job is to sort of protect the registrants to make sure that they're prepared for those outcomes, and really that's them preparing their clients for outcomes.
What impact will central bank digital currencies have on the crypto market? Christine, I know you touched on it a bit, but
I have an interesting opinion on this because once again,
Yep.
I look at it from a technology perspective. So some folks think about these particular central bank digital currencies as programmable money, and the fear is that when you have programmable money, what is it programmed to do, right? Now, if the central banks were coming out and saying, hey, we're going to put this on a public blockchain, so all of those statistics that we showed on one of the slides in terms of the analytics, in terms of the number of wallets and the velocity of money, which is a really important piece of economic data, then the trust level would be there. But it seems that the central bank digital currencies that are being discussed are not being discussed in the context of providing all of that. And so I think that to some degree, if we're going to move everything into this crypto digital world, then there's still going to be a place for these other currencies in which you have your own control, and also in terms of the I guess it won't be printing, but the creation of money. If that continues, we still have the debasing of those currencies. We still have this economic reason as to why people will navigate towards these cryptocurrencies that have all these other facets associated with them. So we have yet to see in terms of how these central banks are going to roll out these currencies. But there are some people who are fearful of the programmability of government money.
Right.
Be tethered out of your account like they did in Cyprus during the financial crisis.
Thank you. We got a few questions here on asking about the differences between Bitcoin and Ethereum.
Bitcoin is the grandfather of it all, and it basically is a store of value and payment platform. Ethereum's great innovation was the programmability, and that gave rise to the ICOs. This whole platform of DeFi, some of the biggest initiatives in the DeFi space are built on Ethereum. So Ethereum is the sort of grandfather of all of this innovation that's taking place on the programmability side and creating that whole dimension. And there's a huge industry that's evolving around DeFi and non-fungible tokens and a variety of different things that are all based on programmability that came from Ethereum.
Okay, thank you. Christina, you touched on this a bit earlier, but the question is, if crypto is so transparent, why do criminals use it? He gives examples of the Colonial Pipeline attack, money laundering out of China, etc.
Yeah, but they've gotten some visibility on that. I mean, that's a good question. So the on-off ramps are where the identity is required, right? So you can see where the money is going, and then when you get to an exchange where the KYC is required, that is where somehow people get caught. As soon as that there's identifiable information that gets associated with a transaction, that's basically how people are caught. And if you look at, Chainalysis and Elliptic and all these companies that are in this forensic space, they're constantly putting out press releases on how they're working with all these agencies and catching criminals. I mean, I think that if you're able to pay with crypto for services and stay in the crypto world, and people are willing to take crypto that's been marked as being part of some sort of a crime. I know that there is a black market for that, but there is a database associated with crypto that's been either stolen or associated with crimes. And if you went to one of the big exchanges to utilize it, it would get flagged. And what they do with the money once you enter your keys and deposit it there is up to them. But so I don't know why the criminals use it. Maybe they can use it for purchasing things on the black market or something.
Okay, thanks. Well, Marie, maybe we should call it there. It's 1:06. We've run a little past our time, and maybe we'll have a follow-up webinar at some point in the future. So stay tuned. And Marie, I'll thanks again to Christina and Sean, and Marie, I'll hand it back to you.
Great, yes. So we're very pleased to have you done this webinar. Thank you very much to Christina and Sean for the sort of very detailed presentation. I know it was a lot to take in, a lot of information there. We will be circulating we will be making available the slides and the webinar recording, so that will be available in the coming days. If you have any questions, please write to designations@csi.ca. And thank you very much for your participation.